you could legally avoid a massive property tax hike on your next real estate purchase. Now, it's not magic, it's a little known strategy that most investors overlook. So, when you buy an investment property, the traditional way, what happens is the county reassesses its value, often leading to a painful increase on your tax bill. Now, there's a smarter way. Now, I'm going to cover what's called the stock purchase agreement strategy. It's also known as a MIPA. But when you buy the entity that owns a property, not the property itself, it's a game changer, but you need to know how to do it right to avoid some of the risks. So in this video, I'm going to break down how the strategy works, when to use it, the pitfalls to avoid, and whether you are a new to real estate or a seasoned real estate investor, this could be the game changer for tax saving that you've been looking for. And one of the other cool things about this strategy is that it's also it has some ways that you can use to purchase other investment properties with this strategy. One way to avoid a large property tax bill when you purchase a property is with the stock purchase agreement strategy. So again, when you traditionally close on a purchase of investment property, the property immediately gets reassessed, thus increasing that tax value. It's it's reassessed at the true value, and the true value is when two parties agree on what it's worth with the purchase price at that closing date. And the county in which this property resides now has the recent data to reassess the true value of this property. And in the eyes of the county now, it warrants an increased tax bill, and unless the purchase price is less than the assessed value, which is highly unlikely, right? Because with inflation that has recently crept up, property values have gone up and not down. And here's how I learned this. So recently, we're working on a transaction where this group of real estate investors who are buying a large group of a large group of townhome community. And by purchasing this townhome community, as soon as they own it, they were going to have to owe a lot of taxes, which is going to pretty much mess up their cash flow in order to be able to service debt and some other expenses. So, how do you avoid the increase of the tax bill? So, by using the stock purchase agreement strategy, and it's similar to when you purchase a stock like Coca-Cola or Apple or whatever on some kind of stock exchange, you what you're doing, or even shares membership interests of a valuable business that I mentioned, you're doing something similar when you do this strategy. So you're in this case, you're buying all the shares or membership interests of the entity, and that owns the real estate. So you're not buying the real estate, you're buying the entity that owns the real estate. Now, there's two ways how this works. And number one, the only way this will work is if the entity that owns the real estate investment property, there's only one entity, right? There's an entity that owns it, meaning that if an individual owns the real estate, there is no entity to buy into, right? If a person owns it. Now, because you can't buy stock or membership interest in a property that's owned by an individual, this is not going to work, right? So that's number one. Number two, also that if there's only one entity that owns the property, so because the likelihood of the seller that owns this entity that owns multiple properties is going to let you buy into this entity is highly unlikely. Now, it could work because then if you buy in the entity, then you're owning multiple properties, but that's if he or she is trying to sell multiple properties. And and if you're thinking about this like true entrepreneur, you're probably thinking, wow, this is a way that I can buy businesses and other things too. Well, I keep on that. Now, what is the risk using this strategy? Making sure that there's no liabilities that you're going to inherit when you buy the interest in the entity owning that investment property, right? Because you're buying into the entity. So when you buy into the entity, what you're buying is you're also buying in all the history, either positive or negative, right? So when is the best time to utilize a strategy? Well, it makes sense to utilize this strategy if the cost of the property taxes messes up your cash flow in owning the property, like I mentioned that party that was looking at that deal. Because at the time, I mentioned it before, I had creating this video, so mortgage rates are higher than they were during the height of the pandemic, right? So so does it really make sense for you, right? Now, also and I'll call this number two, when you have a decent relationship with the seller, you have time to truly explain how how this process works and so that they're okay with it because most individuals that I'm talking about the strategy, even some of the most savvy real estate investors have no clue about this. And and because if they're not aware with this, are they going to be comfortable with this strategy? So if you have a decent relationship with the seller, this is a good strategy to use. Also, when when you're able to rule out, like I talked before, I would call this number three, rule out the liabilities when you inherit the entity. So the best utilizer strategy, number one, when it makes sense for the cash flow. Two, you have a relationship with the seller. Three, when you rule out the liabilities associated with it. All right. So how do you finance a property with this strategy? So very carefully, right? But seriously, no, seriously, it this would typically be treated as a refinance, as the entity that owns the property would be the borrower, and the borrower already has a history of owning this property. So you you'll have to find a lender who's okay with the ownership changes, right? Because when you're thinking of borrower, you're thinking like the individual, but on commercial transactions, typically an entity is owning the asset, like a big multifamily property or a group of properties, a real estate development strip center or something. That I'm talking on some of these big deals where you can have this strategy. Now, how do you do this? What are the steps? Well, the first thing is number one, you want to make sure you have a good team behind you, as there's some legal agreements that have to be drawn up in order to consummate this transaction. And you want to make sure that you're working with professionals that are familiar with and versed with this strategy. Because it's for on the financing standpoint, I'm very aware of this, and we're able to finance this. And then two, as far as connecting you with the right attorneys and that kind of stuff to do this, we're happy to do so if that's necessary for you. But the main goal is for you to understand that this opportunity exists in order to reduce your tax liabilities, and also use this for opportunities to make more acquisition. Now, again, this is a good strategy to avoid a big tax bill, but it also can be used, as I mentioned before, for unique ways on structuring deals and making acquisitions, not just in real estate. Now, another name for this, and I mentioned it before, is the membership interest purchase agreement, also known as MIPA. And the difference between the stock purchase agreement strategy and the MIPA is only in the type of entity that's purchased. So corporation for the stock and the membership interest for an LLC. And definitely make sure you follow us for more information and join some of our free master classes. And we have a an awesome free newsletter down below that you can take access to. And part of that document right there, I think it says 5 ways to finance real estate.